Happy Friday, everybody. So this week we are going to discuss meals expense, going out to eat. Um, some people say I have an accent, and so meals sounds like MILLS, and that can be confusing. But what I am talking about is eating out, MEALS. So I clarify that, kind of an inside joke for me. But anyway, eating out. So as a business owner, you are entitled to meals expense. Now, meals are when you go eating out, it is limited to 50%. So you report the full amount, and then 50% is backed off on the actual tax return. So if you go out and you spend $100 on eating out, you get to actually deduct $50 of that. The logic behind that is that the food you eat isn't really deductible because everybody has to eat, but the business expense portion of it is the food you're buying for a potential client or business partner or whatever, right? So that's kind of the idea behind that. Now, a few years ago, the IRS has been batting around some regulations around being able to deduct mills. Um, and they finalized the regulations a few years ago. So when you actually eat out for a business meal, you are required to keep the five W's: who, what, where, when, why. Um, Mills are too easy, I guess, according to the IRS, to kind of get overly aggressive on, so they want to see proper documentation. That could be as simple as taking the receipt, writing your answers on the back of the receipt, and just saving it for your records. I tell clients that if you're going to do this method, to the most appropriate method, then the best way to do is shoot yourself an email. Um, you pay with your business credit card. So then that's going to run through a third party's monthly statement that you're going practically a legal document. It's coming from a third party financial institution verification source. So this mill will be included as a line item on your monthly statement from the credit card. And then you shoot yourself an email answering the remaining questions. Um, and then just that dates and timestamps it, and you just save the email for future reference should you ever need it. So basically, if you go out with your CPA and eat at McDonald's for lunch and talk some taxes, swipe your business credit card. So your credit card statement's going to say McDonald's for $50, and then you're going to shoot yourself an email and say, met with my CPA and discussed tax planning for 2025. That would be a business mill. And that would be appropriate documentation. Now, that's kind of the conservative method. Um, you just write off every time that and then you cross your T's and you dot your I's, and you write off every time it's a legitimate mill. Um, a more aggressive stance, higher risk, higher reward type mentality would be that we say you are an employee of your company, and so every meal that you eat out becomes at the convenience of the employer. So there are two different types of deductions. There are for mills. There are mills that you go out and basically you meet with, have a business meeting over food. You go out to eat, you meet with potential client, you meet with business partners, you meet with subordinates or whatever, right? Like you're meeting with somebody and having a business meeting where at a restaurant where the meal is included. That is one method to write off mills. The next one is what we call it convenience of the employer, where your mill is an integral part of your operations. Technically, that's 100% deductible, but it can be difficult to distinguish between different mills when that's taking place. So the example of that would be you're on a tight deadline. You're a general contractor. You're building a building. You're on a tight deadline, so you have lunch brought into the job site so that the contractors can quickly eat and then get immediately back to work, or the employees or whoever, right? So the idea is they are eating at the job location because it's at the convenience of the employer to keep them gainfully working towards operations. So we can kind of mix the rules a little bit and not call it tax evasion with the idea that it's higher risk, high reward. So you are your employee if you run an S corporation and you're an office single member LLC S corporate tax as an S corporation, you are the officer and CEO owner employee of this company. So you could bend the rules to say, well, not really bend the rules, but justify to say that anytime you eat out is at convenience of the employer. We run it through meals expense, so it's still 50% deductible, and we don't keep any documentation. Then we say you write off 100% of your eating out with the idea that if you get audited, we're going to negotiate and give some of it back. If you're taking that stance, we write off 100% of your eating out no matter what, with the idea that you are giving some of it back if, in the unlikely event that you're audited. So your first option is keep appropriate documentation. That can become a hassle because you're going to forget. You're going to forget to shoot yourself that email. You're going to forget to take notes. But the first option is you keep appropriate documentation. If you get audited, you have a strong defense and you don't give anything back. If the other option is we take an aggressive stance saying that we're interpreting these laws differently to prevent tax evasion, but it's just a different interpretation of law. And you don't keep any documentation. We write off 100% with the idea that we will probably be negotiating and giving some of it back if you get audited. With that being said, there is a chance that the IRS says no to everything. Now, let's put this into perspective. How much are we actually talking about? Because really, this is just low-hanging fruit for the IRS. Let's say you eat out $10,000 of meals over the year, which is, depending on where you live, could be reasonable. It could be high, it could be low, right? It just depends on your location and how much eating out costs. But $10,000 of meals means that you're actually only going to get to deduct $5,000 of that. And if you are in the 36% bracket, that means you're actually only getting a $1,800 for dollar deduction on your taxes. So, in all reality, if you take $10,000 of expenses in meals, that's only going to save you $1,800 in actual taxes. If we times that by a failure to pay penalty and some interest, we're probably capping out at about $2,000 is the amount of money that we are actually talking about in an audit, plus or minus maybe $100. Um, so just keep that in mind. Like, on a year by year basis, $2,000 every year, saving up over time, can become substantial. It's a pretty decent return on investment on $10,000 of expense. Um, but that of any given year of your chance of being audited, that's pretty low risk. And if you are audited, that's how much you're leaving on the table for the chopping block. So that's your risk, about $2,000 that you're going to have to pay back. So just keep that in mind as well. So my job is to help you understand how to be aggressive, understand the risks of that aggressive stance, and the reason why I think it's legitimate that we can do that. And so that's kind of where my stance on mills is. You have your two options: fully compliant, keep proper documentation, hope you never forget, and you only write off what you actually keep good documentation for. Or we write off 100% with the idea that we are going to give some of it back, with the risk being that you might end up having to give all of it back if we can't even present a decent argument to any auditor. It does provide them low-hanging fruit where they might go, hey, we got a $2,000 adjustment on this return, and they are happy, and we are able to negotiate and keep something a little bit more lucrative that would present more of a challenge for the IRS. So those are some of the thoughts behind it. Hopefully this helps people understand what you can deduct for your meals and eating out, and the proper way versus a slightly more aggressive way. So Everybody have a great weekend and have a good week next week.